There is a massive shockwave heading straight for the Indian economy, and it comes with a number, a very, very big number. We're going to break down exactly what that means for businesses, for investors, and, for the country as a whole. Okay, let's get right into it. 3.7 trillion rupees. Just let that sink in for a second. That's the potential economic cost of this oil price crisis. The report we're looking at today says it's the biggest threat to industrial profits that India has faced in 2 decades. So where on earth does a number like that come from?
Well, it comes from a critical intelligence report put out by the Industrial Front. Now, we've gone through all 40 pages and distilled the absolute key insights for you, so think of this as the audio guide to that report. We're going to cover how we got here, looking at the global price spike, then we'll zoom right into the shockwave hitting India specifically, and finally, we'll look at what might happen next.
So, first things first, let's look at the global picture. How did we get here? Why is this all happening right now? Because this isn't just random market noise. It's a story of some very real disruptions happening out in the world.
What's just staggering is the speed of this thing. I mean, look at this timeline. In just 9 weeks, the price of crude oil shot up by a whopping 70%. We went from a pretty stable $71 a barrel all the way up to a peak of $120. The report points out that this is actually the fastest spike we've seen since the financial crisis back in 2008.
And the main reason for that? Well, it's geopolitical escalation. The Middle East, which, is responsible for nearly a third of all the crude oil the entire world uses, is facing some serious problems getting that oil out. This is a classic supply shock. It's as simple as that. And this table here breaks it down beautifully. You can see how that supply shock turns into a higher price. The report talks about a risk premium getting added to every barrel. So, you've got partial disruptions in Saudi Arabia alone adding $15 to $20. Then you tack on the issues in the UAE, the logistical problems in Iraq, and suddenly you see how we got to these crazy high prices so fast.
Okay, so that's the fire starting on the global stage. Now let's talk about how that fire is jumping over to India and creating this huge economic shockwave.
So here's the core of the problem for India, our dependency. This chart really says it all. We import 85% of our crude oil. 85%. That kind of dependency is a massive structural weakness, and it's exactly why a global price spike like this one hits our economies so incredibly hard.
And here's how that pain spreads through the whole system. The report calls it the transmission mechanism, but honestly, it's just like a set of dominoes falling. First, bam, fuel costs go up. That makes our total import bill way bigger, which puts pressure on the rupee. That, in turn, leads to higher inflation for everything, which then forces the RBI to step in and raise interest rates. See? It's a chain reaction.
And let's just double-click on that second domino for a second, the import bill. This chart shows the impact on our current account deficit, or CAD. Basically, a higher oil import bill means we're sending way more foreign currency out than we're bringing in. The CAD is expected to jump from a manageable 1.4% of GDP to a much more worrying 2.1%. That's a huge red flag for the country's economic health.
All right, so we've seen the big macro picture. But what does this really mean for actual companies on the ground? Because this oil shock isn't hitting everyone the same way. Not at all. It's creating a very clear divide between winners and losers.
And this table captures that divide perfectly. On one side, you have the winners. Upstream producers like ONGC, the companies that actually sell crude oil, are seeing their earnings jump. But on the other side, you have the losers. Take the airline industry. Fuel is nearly half of their operating cost. They are getting absolutely hammered, facing just staggering losses.
And if you look at it in terms of profit margins, the story is even more stark. Upstream energy companies are looking at a 20 to 30% upside to their earnings. But for sectors that use a lot of fuel and oil-based products, think aviation, logistics, even paints, they're facing a severe compression of their margins. Their profits are getting squeezed big time.
So, knowing all this, the million-dollar question, or maybe the trillion-rupee question, is what happens next? Well, the Industrial Front report doesn't just lay out the problem. It actually game plans 3 possible futures we could be looking at over the next 6 to 12 months.
First up is the optimistic one, Scenario A, which the report gives a 30% chance of happening. This is the rapid recovery. It's based on the idea of a quick diplomatic fix in the Middle East, which would let prices fall back to a more normal $85 to $90 range. If this happens, the economic pain would be sharp, but thankfully pretty short-lived.
Next is scenario B, which is what the report calls the base case, the most likely outcome, with a 50% probability. Here, oil prices don't crash, but they don't stay at the peak either. They just kind of linger over $100 a barrel for a while. This would almost certainly force the RBI to keep hiking interest rates, meaning it would be a long, grinding period of pressure for businesses. And finally, we have the downside. Scenario C. The report gives this a 20% chance. This is the grim one, where the tensions don't ease up and oil prices stay stuck above $120. In this world, the report warns weaker companies could face real crises of survival. This is the scenario where that full, staggering 3.7 trillion rupee economic hit becomes a reality.
So what do you do about it? The report lays out some very clear, actionable advice for business leaders. The main message is to act fast. Immediately look into hedging fuel costs, tighten up all your expenses, and start trying to renegotiate contracts. But maybe the most important takeaway is this. Use this crisis as the motivation to finally make those big investments in becoming less dependent on oil.
And for investors, the advice is just as direct. It's almost like a traffic light. The report gives a clear green light to upstream energy producers like ONGC. It's a hard red light for the aviation sector, maybe best to avoid it for now, and it gives a cautious yellow light to defensive, export-focused sectors like pharma and textiles, which could actually do okay in this environment.
And I think this quote from the report really sums it all up. The scale of the challenge is huge, the biggest disruption to profits in 20 years. But there's a really crucial second part to that sentence. The shock is described as acute, not permanent. It's like a severe storm. It's going to be rough, but the key is that it will eventually pass.
Which leaves us with the final and most critical question. Are we just going to weather this storm and then go back to business as usual? Or is this painful shock going to be the permanent catalyst that finally forces India to make real strategic changes to secure its energy future? The answer to that is going to define our economy for years to come.